Kalimera Anthropos, welcome everybody to O Economica, all about economics and finance, and thanks a lot to all new subscribers. That means a lot to me, and Happy New Year. And if you're new around here, please subscribe, because I will provide you for free a lot of macro economic research. So we will see together what it's happening into the global economy, what that means for your your business, for your salary, for your wages, and so forth and so on. And from time to time, I will share with you also some updates on the stock market, although it's not my favorite topic. So while I was reading this Bayesian macroeconometric paper, and if I can sort out this thing, that will be great. So while I was reading this Bayesian macroeconometric paper, I just realized that because 2026 has started so wonderfully, I want to share with you my thoughts, really, on why I'm about to say what I'm about to say, which is something that everybody knows. And what I'm about to say is that for 2026 and going forward, probably, bear in mind I don't have a pen, don't invest in stocks. Why I'm saying this? Because not only because probably it can be fancy, or I want to seem to be a contrarian or something like that. There are many reasons why it's not a good idea to invest in stocks. And first of all, there are economic reasons. But the first reason that I want to share with you is that investing in stocks generates a misallocation of money, otherwise said of capital. Why I'm saying that? Because first of all, stocks still are very risky products, because whenever a company goes bust, okay, if I have a company here which is I don't know, company ABC, this is common knowledge, okay, it's not really necessary for me to explain it. I'm not explaining anything. This goddamn thing doesn't want to work. So what do we have is that if company ABC goes bust, basically who gets money back is bond holders, bond investors. They are first, okay? Because this word, this ordinal third first, it's so trendy, belatedly. Sorry about that. So this, because this first word, never mind. Okay, so ABC goes bust. ABC is bust. It's bankrupt. Who gets money? It's bond holders. If you own equity or stocks, your money equals zero. Okay, you have no right to claim anything, any compensation, anything. Okay, so it's 100%. It's investing in stocks or equities. It's 110% risk of loss. So it means that all your savings, or your 401k, so forth and so on, if you are somewhere else, like your pension investments or that kind of stuff, it goes to zero. Okay, you are going to be literally wiped out. Your money is going to vaporize in any stock market meltdown. And so first reason is that stocks, they are absolutely terrible. They are a humongous risky product that I will never give my money to. So, as I said, investing in stocks generates a misallocation of capital. Why? Because if you are an employee, okay, so when you invest in stocks, okay, when you invest in stocks, you have a claim on company ABC. If I give you a piece of equity, you have a claim if it's paid on dividends, okay? If and when company ABC can pay dividends, okay? So let's say that you have you are, or anyone, it's an employee, employee, of company XYZ, and you take a piece of equity, okay, in company ABC, right? Let's see if I can work it out. Okay. Now, when you take a piece of equity in company ABC, why is that a misallocation of capital? Because that grows the market cap of the company, market capitalization. So the overall value of the company in the stock market, it goes higher. It expands by the amount on leverage that you are an investor is putting into the company. So the market capitalization basically is the share price, okay, it equals the share price, the stock price, times the number of shares, okay, number of shares. It's a pretty straightforward, number of stocks available, etc, etc. But, okay, now the employee in XYZ would like to have a dividend. Okay, what happens is that more often company ABC, to pay a dividend from this piece of equity, it has to be very, very efficient. Not only it has to be profitable, it has to have a positive cash flow at the end of the quarter and at the end of the year, but it has to be very efficient. It has to be very strict on the managing of the business, which I'm not saying that efficiency it's wrong. Efficiency it's important, productivity it's important, but what happens is that employee at ABC probably will see that its wage is constrained. Why? Because ABC, it has to pay the dividend claim of its shareholders. Okay. Now, on a broader scale, we know that this functioning or this dysfunctional stock market system works on very large amounts, hundreds of millions, billions, etc. And so the investors, they pool a lot of money and they speculate on stocks, on companies' equities. They speculate on this company, the other company, what is the latest innovation, artificial intelligence, so forth and so on. And that goes to my my first point, that all of this market capitalization creates a misallocation of money, resources. Why? Because when you buy a certain amount of stocks in a company, it can be anything that you like, I don't know, Kraft Heinz or Oracle, I don't know, I cannot sponsor anyone. Your money goes into the market capitalization of the company. So that means that the stock price grows. Okay. So when you invest into a company, you invest into a company because you want to have a return for yourself. You want the dividends, or you want to make capital gains. Okay. But that money does not necessarily, market capitalization does not improve productivity, okay, and efficiency. And at the end of the day, it does not improve wages necessarily, because if I don't have an improvement in the company productivity and in the efficiency of any business in generating its own output, then also the wages of the employees will not improve. And that's why you have been wondering why you have been working your ass off, and you have seen your wages not growing, but you have only see prices go higher and higher and higher. So what that means is that asset price inflation, it's a determinant factor of consumer prices inflation, because businesses, to generate these dividends, they need to be profitable, and because productivity and efficiency does not improve when we invest into the market capitalization of a company, what that happens is that they need to raise prices regardless of what is the level of productivity, efficiency, and the level of wages, especially regardless the levels of wages. And so what that happens is that you have a misallocation of money resources, of the money supply, because it goes into the stock of the equity component, which is not a productive part, it's just a claim on the future cash flow of the company. And basically you want that at the same time that the company, the business you have invested in, you own the shares of this company, it becomes more productive, more efficient, and it pays higher wages, and it gives you capital gains of your shares and pays your dividend. All of that, it's fantasy. It's total fantasy, okay? And when I say that, I've just said that this economic model that it's propagated in the past 100 years or more, it may be good, it may be bad. To me, it's inefficient, okay? Because you cannot have an efficient company which pays higher wages and at the same time it pays dividends, or it does not have like a monopolistic market share so that they can set price, they have an assured large scale profit, and so they can decide anything in the market, from the price of their products, the level of their production, the barriers of entry into the market, so forth and so on. So to have that kind of idea that you can invest your wage, your annual wage, into the stock market, you need to have a oligopolistic kind of economic system, so where there are very large conglomerates which have mostly very large, almost monopolistic market share in their industrial sector, goods or services, and so they can set the level of prices at which they want, and even if it's the lowest marginal price that they can set it, because it's a quasi monopolistic market, then they will have an assured profit on a large scale, and they can then decide how much output, how much production they want to inject into the market, because they are the monopolistic agents, economic agents in that sector, and so they can decide the level of output and prices, and they can decide the level of wages, and then what happens is that they become monopsonies in the labor market, because then people are underutilized, they are human capital is underutilized, or it's not the level of wages, it keeps stagnating, so forth and so on. So investing in stocks, it does not, that's my humble knowledge, it does not generate a positive return in economic terms. First of all, because it's risky. Okay, if company ABC goes bust, your equity, your claim on the company, it's zero. You are entitled to nothing. Okay, so who gets refunded are bond investors. Okay, because bond, it's also a, let's call it a liability of the company, but there are some legalities involved in a bond investment. So the company, by legislation, it's forced to service bond investors in some capacity whenever it goes bust or it goes into administration, so forth and so on, it files for Chapter 11, whatever it is. Okay, bonds investors, they are going to be refunded, I don't know, 60, 70% of the value, 50%. It may take some time. It's not easy, but at least you're going to be refunded of something. While instead, if you have all of your savings into stocks, into ETFs, or into any, even worse, in stable coins, crypto, so forth and so on, whenever at some point the stock market, the value of the stock market is going to deflate because of the misallocation of money resources, okay, because the dysfunction of the whole economic system, okay, when any system goes to the extremes, it falls out of balance and then it collapses. So the speculation in the stock market, when it's pushed to the extremes, as it is now, or it has been for the past decades or more, then the whole underpinning economic function, the socio-economic construct, people that go to work, pay their wages, put their money in their 401k, or people go to work and stack their money into their pension funds, which is invest in stocks and risky stuff, so forth and so on. When this system goes to the extreme and goes out of balance, then it collapses. So when the system collapsed, equities go to zero. All right, zero. You're going to be wiped out. You're going to be literally robbed of your savings. Okay, and so there are two components: the total risk of losing all of your savings. Second, if you are investing in stocks, you are not helping anyone, not even yourself, because you are taking an absolute risk of being wiped out, of being robbed. Why you're going to be robbed? Because the same fund or the same bank, okay, can be JP Morgan, Morgan Stanley, Goldman Sachs, State Street, BlackRock, Deutsche Bank, Barclays, you name it. All the big banks and all this constellation of private equity funds, all these people who want to manage your money, etc., 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 to the last of the list of the people who are on YouTube and say, okay, you need to accumulate this, that, and the other, invest into this ETF, etc., etc., etc. What they do not tell you is that if anything goes wrong, you have lost everything. Everything. Okay? So, you're not, if you are putting your savings for retirement into stocks, I'm not saying that it's bad, but I don't believe you're doing a huge service to yourself, because you are taking on an absolute risk of losing everything. Because it doesn't matter if the pension funds it's invest in stocks, they are not going to be rescued. Okay, at least you will lose, I don't know, 50, 60, 70, 80% of the value, of the initial value of your investment, because when the stock price goes back to a normal level, then you have a loss. You have a loss on your investment. Okay, you're going to end up with less money that you put in. And so why you're going to get robbed? Because all these banks which are selling you a product, they take your money. They tell you you have to be invest. At the end of the fanfare, when everything becomes unsustainable, the large investors, they will dump stocks while people they are still excited about the market, they will cash, they will take money, and all that market capitalization, this one, or where all the millions of people, retail investors have invested into, okay, it will vaporize. It will become basically cash for the large financiers. Okay, how Elon Musk will have 100, 200, 300 billion? He will rob, or it's actually robbing its equity investors, because Musk it's cashing in on Tesla stock. Okay, while creating all this propaganda of investing into the stocks and Tesla shares, or what is SpaceX and so forth and so on. They issue shares, okay, and you take shares. The employee takes shares through the pack. But what they're giving you, it's a pack. It's a it's an empty box. That pack, accumulation plan, it's an empty box. Okay, you are basically subsidizing the lifestyle of Jamie Dimons or Larry Fink or Elon Musk. You are subsidizing their lifestyle, because you are giving your wages and your savings to these people who at the end of the day they will leave you with nothing. And on the other side, what happens is that the employees, the other people like you who work in any corporate, in any business, they will see their standard of living being squeezed and squeezed and squeezed, because the company, it has to be profitable and it has to pay shareholders or these large pension funds, so forth and so on, with dividends. And so they will have to cut on what? On efficiency, on productivity, and they will have to cut on wages. So investing in equity is not good for the investor unless you are a big investor, and it's not good for the economy, because the economy does not improve, because you have a misallocation of resources, which derives by the fact that when you buy share, your money goes into the market capitalization. The firm, by legislation, they cannot touch the shareholders' money and do whatever they want. Okay, so they cannot take your money. If you invest in Nvidia, okay, the CEO of Nvidia, they cannot take the equity holders' money and do investments. That would be against the law. So their investment in shares or in equities, it does not improve the productivity of the company, and in the end of the day, it does not improve wages. What does generate, what is the allocation of money resources or money supply that generates investment? It's bond investments. So that's why now we have, for example, anyone is familiar there in the media outlets, and they are all, because they want to brainwash the people, and they want to fuel the speculation in stocks, and say, okay, these companies, these AI companies, they will be profitable. So what ABC does, ABC issues corporate bond, corporate ABC bond. Okay, so they issue debt, corporate debt. So at the end of the day, what is required for the functioning of the economy are almost 90% of the time, they are debt instruments. Okay, so I'm not a believer, okay, in anything. Okay, I'm not a believer, because believing in something means to be ignorant of something. So I'm not a believer of equity financing, because equity financing, it does not work, especially if it's in public markets, because you are only inflating the market capitalization of the company without generating anything, any improvement in productivity, wages, in efficiency of the company, so forth and so on. The company, to be more efficient, any business, it has to issue debt. And on the basis of the corporate bond yield, okay, in percentages, you have the discount factor, of the cash flow, and so of the of all the business operations. Okay, so at which level I have to discount my capital requirements. Okay, so it's a matter, efficiency starts with having a discounting factor parameter which tells me, okay, to fund my business I have to discount the cost of money of funding my business by this percentage, this yield. Okay, once I know what is the cost of funding my business, around that I will be way more focused on generating efficiency, productivity, and then setting a level of wages. So what is all the working capital stuff and all the variable parts of the working capital, or which is the labor input, so forth and so on. So you have fixed investment, which can be fixed investment, which is the machineries and buildings, so forth and so on. And then you have the variable parts, which are wages, more or less. But wages, they are variable in the short term. In the beginning of a business, they are variable because there is more turnover in hiring people. Then wages in a stable firm which works for more than 5-10 years, then wages, they tend to become more a feature of a fixed cost. Okay, there are fixed costs, variable costs, so forth and so on. I'm not an expert in this, but at the end of the day, what sets in motion the improvement into the economy and into the standard of living of ordinary people, of the employee of XYZ which wants to buy shares in the company of ABC, it's the issuance of corporate debt or some sort of financing, which then becomes capex. Okay, capital expenditure. So the company does, any business does investment in hiring more people, in buying new machineries which are more efficient, in acquiring patents or intangible assets, which can be new softwares, new technologies, intellectual properties, so forth and so on. So that's why investing in stocks, it's at this point meaningless, because to have a real investment cycle for capex, okay, you need businesses to issue debt. It's the same of governments. If you want the government to do an investment for you, the government will have to do fiscal deficit. How they do fiscal deficit? They have to issue sovereign debt, which has a yield, and it pays a coupon every 6 months, and then an investor is protected 100% on sovereign debt, and it receives a coupon payment every 6 months on the notional amount of the investment that has been made. Okay, so we get to the point that corporate debt is necessary for or debt instruments of some sorts are necessary for the improvement that we would like to see in an economic system, including higher wages. So how do we provide capital for this to happen? We have to stop the misallocation of money resources. We have to stop doing that. And in what sense? If you are an employee, Jesus Christ, because I'm using a mouse. So if you are an employee of ABC, you don't want your money to go into stocks. Employee of ABC, okay? You don't want your money to go into stocks. You want your money to be in your checking account, deposit account. Money is our deposit into the bank, deposit or saving account. Saving account. And this, I want to open some brackets here. Why all these gurus on YouTube, which tells you, okay, you need to invest in ETFs, so forth and so on. They will tell you, okay, but before you start to invest with my suggestion, because I wrote this, that, the other book on what is being financially independent and all these Ponzi schemes stupidity, okay? They will tell you, okay, but you need first of all to have a rainy day funds. So you need to have first of all some savings for all your necessity in case something happens. What is that something that can happen? Is that when you invest in ETFs, in stocks, so forth and so on, whether you do it by yourself, if you do it by yourself, it's very, very risky, or whether you do it in the long term with some money managers, you have to be invest. And once you give them your money, you are not going to see your money back. At least you will see what you're doing in the interim. In the meanwhile, you are financing the lifestyle of these scumbags in Wall Street. That's what you're doing, or in Frankfurt, or in Milan, Paris, London. You're just financing their lifestyles. They go with their Mercedes or their Lamborghinis, their Bentleys, their Rolls Royce, so forth, and their Porsche. And at the end of the day, you will not see your money back. And I will tell you in a while. So, you don't want to invest in stocks. What you want to have is to have savings. Just have money, cash. You want to build a pile of cash, of savings in your saving account, okay, and sits there. It earns some very low interest. But you say, oh, there is inflation, you are losing purchasing power. It's true, but for the economy to work, okay, if the employee of ABC, if has a pot of money, okay, they can do two things. They can buy a house, okay, buy a house, and eventually to buy a house you will have to issue to enter into a contract of a debt instrument, which is a mortgage, okay, or you can open a business, make a business, not make but fund a business, okay. So if you have savings, you can take your own venture, fund a business of your own. You can fund a business of your own. At that point, you know that you can be successful or not successful, but you are fully aware that it's your choice, and you know that you are taking on business risk, okay? With business, there is business enterprise risk. Enterprise risk. Okay, but having a business, it means that you are selling ice creams, lemonades, or cookies, is not the same risk as being exposed to the volatility of the stock market every day. And your money are locked for the next 10, 20, 30, 40 years, and you don't know if you're going to see your money back or not. So, the first two things, the first two choices that you have, okay, if you break out, if you want to be a glitch into the system, and you want to break from the matrix of being invested into the stock market, when you have your savings, you can do two things. You can buy a house, you can fund your business. The third choice is that when you have a pool of savings into the economy, what happens? Happens something very natural. Pool of savings. What happens is that there is money resources available for businesses. So not only the employee in ABC can do its business. When I have a pool of savings in banks, okay, and the bank deposit, I have money resources for this, which is a static classic model. So when we consider a liquidity money line curve, okay, here we have GDP, here we have our interest rate, and we have another curve, which is the investment, saving and investments curve. Okay, so for a certain level of interest rate, I will have an equilibria of, in the liquidity LM curve, liquidity money preference curve, a level of investment and savings, or savings and investments. Now, and at this level, this equilibria, I will have a GDP potential, which is not potential, but it's a very, very simple model. I have a level of GDP here, economic growth, let's call it 1%. Okay. Now, when in aggregate, we do our bits and save our money and put it into the bank, and we don't chase useless speculation, it means that the availability of liquidity or money into the system, it's abundant. It's sufficient for banks to issue liquidity, to utilize that liquidity for the employee of XYZ, of I don't know, any other business, to buy a house or to fund a business. Okay, so I'm an employee of I don't know, a coffee shop. Okay, I've saved a lot of money and I want to open my business, so I have my savings. What do I need? The liquidity that I need, it comes from the pool of savings in aggregate into the economy, which is the LM curve, at a certain level of interest rate that corresponds to the equilibria between money and the reserves of money and prices. It's a bit more nuanced than that. But the more savings there are into the economy, the lower can be the level of interest rate eventually that businesses will have to pay to banks to fund their activities. What happens is that when, the same as interest rate, when interest rate goes down, what happens is on savings, okay, we have a new equilibria point, which is here, perhaps. So if on my checking deposit I'm earning 3%, 4% just on savings, and then there is a lot of savings into the system, and so that means that there is not so high inflation, and the central banks can reduce the cost of borrowing, so it means that R goes down. It means that also my interests yielding on my checking, on my deposit or saving account will go down. So it means that my preference in the liquidity money curve will change, will shift from what? From saving to investment. When there is more investment, this line, which is GDP, it goes here and it finds a new equilibria here. And magically GDP moves along this line and it becomes 2%. Why? Because there is less incentives, there is less request for money to be parked into the bank in savings, but there is more request for investment. Okay, when there is more investment, then GDP goes up. Okay, and also the preference of the liquidity money curve changes. So that's another effective benefit for any socioeconomic construct in utilizing money wisely. Don't take your money and you give it to the next asset manager. I would not even put it in the 401ks, but nowadays in the United States you are forced by your company to stack money in 401ks. You are a forced slave to pile up your money into the stock market, even if you don't want to. Even if you don't want it to, you are forced to do the 401k, because otherwise it's a disaster. For how do I see things? It's better to have a lot of savings so that we can finance businesses or houses, okay? And we do less of inflating the market capitalization of companies, which basically then become so large that they become monopolies, okay? Because when there are savings, there are more small and medium size enterprise, more SMEs. So it means that anyone, it has a possibility of going to the bank and asking for some support in running a business or opening a business, okay? And when you have your own economic activity, that creates GDP. It frees up a space for somebody. If you are an employee and you go into your private business, it means that your employee place, it's free, and then somebody who is unemployed potentially goes to fill up that vacancy, and then there is one more business that has been created. So overall, it's natural that gross domestic product in aggregate, it grows, because you have more business creation, you have more people who are pulled from, there is more demand for labor input, okay? So it's not that we need lower interest rate for the sake of having lower interest rate. We need a better allocation of money resources. If we keep printing money, if we keep issuing debt, and all this money goes into the stock market, we are going to get to a point where the economy is so unbalanced to the extreme that everything falls apart. And all your money that you have in stocks and shares and ETFs, it will be wiped out. You will be robbed, because the asset manager who is managing your money, it will walk away with the money, and you will be left with pennies, okay? So the best thing to do is to keep your money for yourself into the bank, and you will decide if you want to buy a house, if you want to fund your business, if you want to pay for your wedding, for all the expense. You want to take a life insurance, injuries insurance, you want to travel the world, but do not invest in stocks and shares or ETFs, because it's bad for the economy. It's only good for the financial sector, but it's bad for everybody, even for yourself, because you take the risk of losing 100% of your capital, because shareholders, they have no right to claim on anything. If any business goes bust, you have no rights to claim anything. If you are a preferred shareholder, you may have some rights, but you are not a preferred shareholder, you are not an equity holder, or you are not an equity funder of Uber or Just Eat or Deliveroo or I don't know, JP Morgan, whatever. You don't own the company. You are just an ordinary shareholder among the many millions and billions of shareholders. You have no right to claim anything. And so your money, your capital, goes towards funding the business of somebody else. So what happens is that you take the business risk of somebody who does not reward you for anything. It gives you like a dividend payment of a few dollars or a few pennies once in a while, right? And then you have to stomach all the speculation on stock prices that go up and down, okay? And the volatility in the stock price, it does not follow your wishes, but it's functional to the speculators. So the safest thing to do and the best thing to do is to save liquidity. It's healthy. It's healthier, because when banks, they have liquidity, they go out into the market, and they buy treasuries. They may buy treasuries which yield for your saving account. So this is a positive dynamic that goes into the economy. There needs to be an equilibrium between consuming and saving, and that is a cultural feature of any socio-economic construct, okay? But I repeat again the same thing. Do not invest in stocks, because it's too risky, and it's not, you may have capital gains, okay? If you are clever, if you're good, you can have capital gains, but it's not beneficial to you, because when you have capital gains, there is no efficiency. You will find that those capital gains, they will have to pay for higher inflation in the grocery shop. So it's a dog that is wagging its tail. it doesn't matter, because asset prices inflation, it's a main component of inflation in the economy, because corporates, they need profits, and to make profits they need to hike prices, and so prices go up in the economy for ordinary consumers, for your wages, as well as stock prices go up, and these mechanisms cannot go on indefinitely. The economy will tip out of balance, and the stock prices will lose huge 30, 40, 50, 70, 80% of their value. And many companies, like the new AI companies, will go bust. So you will basically lose everything. And when you are a shareholder, you have no right to claim anything on the company when it goes bust. You have some rights only if you are a bond holder, if you are a debt holder. Okay? So the best thing to do is to have savings, and you decide if you want your business, if you want to fund your wedding, so forth and so on. And having more savings into the economy, it helps GDP, because we have lower interest rate. We have the possibility of having organic lower interest rate, because inflation, it's not so high, because people are saving a little bit more than they are consuming, or they are 50% consuming, 50% savings. But crucially, there is not this push factor of asset prices. When there is a lower equilibria of interest rate, which is in line with inflation, then GDP grows, because there is more money available for funding small and medium enterprises. And then more jobs, more vacancies, more job or labor input demand, it's created. So there is a need for more labor, because there are more businesses. And then if you are an individual who wants to fund a company, then you are in charge of your own destiny. You take on business risk. But when you buy shares, you give your money to somebody, and then you take the business risk of a business which is not your own business, on a company of which, if you buy shares in any company, in in Microsoft, okay, you take the business risk of Microsoft. You may take capital gains, but you don't have a claim on the company. If the company goes bust, or Apple, or Barclays, whatever, anything. So you are totally unprotected, rather than having your business and managing your own affairs. And when there are a lot of savings, then the bank goes into the market and buys treasuries, and that allows for the level of interest rate also for government to be contained, to be lower. Okay, so the more we keep doing this speculative financial asset inflation, asset prices inflation, the worst is going to be your wage, your standard of living, and your future prospect. And in the worst case, that you are you have savings in your Vanguard ETF and stuff like that, you have more than 100% risk of seeing your saving really depleted if anything goes wrong into the market. And from time to time, we know that the business cycle into the financial system requires, when there is too much inflation in assets, then something happens, okay? And the speculators, they walk away with your money. So that's my humble arguing, and I could go on and on and on and on and on and on and on, because there are so many things which can demonstrate why we need more liquidity in banks, more savings. We need to build up more savings. We need the overall society to have a change. I don't want to, probably I'm wrong, I don't want to impose anything on anyone, but if you think rationally and you see that the stock market is a speculation and it's very risky, eventually the safest thing to do is to keep your money for yourself. My suggestion is, do not invest into the stock market, do not invest into ETFs, and all that sort of things, because you are going to pay fees, fees, or commissions, and even if you want to abate the cost, so forth and so on. But just have liquidity in your bank account, and if there is a change, a shift in the whole population, you will see that then the economy improves, because the cost of borrowing for the private economy and for businesses, for households, and for the government, it eventually becomes less expensive. Okay, because we don't have assets inflation, but we have enough saving into the economy to fulfill the issuance of treasuries, of debt from the government, and the request of liquidity from small and medium enterprises, which can carry and do their business and produce their products. And so also we don't end up in a monopolistic, oligopolistic, constrained economic system where all the money goes to the same large multinationals, and we don't have choices. We don't have money to make our own business. We have to take their products. We have to take their prices. We don't have any choice, substantially. So if you want to own your destiny, the first thing to do is to keep your money into the bank. Don't touch it. Just save it. You can do like put it in a pot for your late retirement. You can take some injury or life insurance, so forth and so on. But do not give your money to any asset manager for investing in stocks and ETFs. That's my humble suggestion for 2026, and I will come back for more.